Hi, this is Jason, Chief Technical Analyst with ToroAlerts, and this is your weekly market recap for the week ending September 23rd. Had a pretty rough week in the markets. If you were long, we saw quite a bit of selling pressure starting on Tuesday, ultimately seeing the S&P 500 on our SPY chart finishing the week out down at about 367.95. However, we did get a nice hammer candlestick we can see on this chart here, and it looks like we might have some opportunity for a rebound going into next week. I think there's a lot of charts we're going to dive into and take a look at that are kind of suggesting that we might have a short-term bottom in. One of those being, other than just this hammer candlestick, we also basically closed down at the previous June lows, and so I think that's a pretty logical place for us to see a short-term bounce on this. And so this is definitely not the week I'd be jumping into a bunch of new shorts right now. In fact, I closed most of my shorts out at the end of Friday, and be looking actually for some brief bounce opportunities to the upside. Take a look at the S&P 500 chart here on the SPY. I'd be looking at either an upside target of maybe about 380 or possibly getting as high as 390 again on the SPY before we roll over. And so if we do get that bounce, I'll be trading that one to the upside and looking for an exit at one of those levels, either 380 or 390 on the SPY. And then ultimately, I do believe we are headed much lower from there. So if you are going to trade this bounce, first make sure that bounce does happen and confirm it on Monday morning. And then also just be really tight with your stop losses, be ready to get out of that trade, because I do believe it'll be fairly short-lived. We can jump over to the S&P 500 charts, taking a look at some breadth indicators. These two charts on the bottom here is actually showing us the percentage of stocks in the S&P 500 that are above its 200-day moving average, and then the green line below is above the 50-day moving average. So we can see that we've only got about 5% of S&P 500 stocks that are currently above their 50-day moving average, and only about 15% above their 200-day. So there's quite a bit of weakness across the markets currently as well. And then when we jump over to our NASDAQ, our triple Qs, we can see that we also ultimately bottomed out at the previous June lows. Had a decent little hammer candlestick to finish the day out, and this chart also looks like we're probably set up for a short-term bounce. And so I'll be looking for potential upside target around 282, 283, or possibly up to this down channel trend line. Might get us up to about the 290 level, maybe about 295 or so at the most, but I would expect probably a rollover somewhere around there. So I'll be watching the price action really closely on this trade, as it very well might just be a couple of days before we see an ultimate move to the downside once again. But I do think we are going to get a little bit of a bounce in the NASDAQ as well. And then when we take a look at our Dow Jones Industrial Averages, we actually saw a deeper sell-off in this one, which is a little bit surprising. But we did drop below the June lows, but we ultimately got a pretty big hammer candlestick on this one as well, and it just about closed right around those June lows ultimately on that Friday at the end of market close. So this one's also looking set up for a short-term bounce. If we do see that bounce, I'd be looking at for some upside targets at around either 307 or about 311, 312. And then I'd be looking to probably re-enter some shorts once we get up to those levels. And then when we take a look at our Dow Jones Transportation Index, we did drop below our 200-week moving average. These are weekly candlesticks we're looking at. So I was definitely fairly bearish, but if we do see the general markets bounce, we'll likely see a bounce here as well. So if that does occur, we'll probably see it get back up at least to this anchored VWAP position, which would be about 12,440, or we might get all the way back up to our 150-week moving average, which would put us right around 13,000 if we get a bigger rebound on the transports before ultimately heading lower. The next target to the downside on our transports that we're looking at is about 11,400, as that's acted as resistance quite a few times in previous years, going back into 2018, 2019, as well as the 2020 highs before the COVID crash. So that's a pretty key support level to watch for at that 11,400 once we do ultimately head lower on the transports. And then take a look at a Russell 3000 chart, our RUA. This also is another reason why I think we had a really logical spot for bottom, as we did basically sit as at support on this 200-week moving average. This is 300 stocks in the stock market, so it's a very broad basket, and I think that's a very logical place for us to see a short-term bounce. So if we do see that bounce occur, we could see the Russell 3000 get back up to that 150-week moving average, which would put us at about 2250. or if we really get a little bit bigger of a rally, we could maybe get all the way back up to this middle channel line, which would be somewhere about 2350, 2400 at the most. And then ultimately, still thinking that we head lower and get at least down to this down channel trend line, if not further, which is down right around 2,000 or so on the Russell 3000. And then take a look at our large caps. Our Russell 1000 also saw a bounce off of the 200-week moving average. So again, looking for a good logical place for support on our large caps as well. And we could very well see a bounce there, looking at potentially that 214, 213 level, which would be our 100-week moving average. Or if we did see a bigger rally in the large caps, maybe we get all the way back up to 230. That's probably a bit too much for large caps, I would imagine, on this short-term bounce, but those would be the two levels I'd be watching for. And then our Russell 2000, we saw it blow down below our 200-week moving average. We actually closed or opened the week right below it, and then we ultimately just headed lower, got down to about our June lows in small caps as well, and looking like we're probably set up for a short-term bounce there as well. So logical place up here would probably be the 200-week moving average, I'd imagine, and then we'll probably continue lower from there. And then taking a look at our growth versus our value. Growth looks like it's sitting at support at around our 200-week moving average as well. So we've been a lot of charts here sitting at that 200-week moving average right now. Very likely to act as support, and we might see a brief outperformance in growth over value. If we do get this short-term rally, might be growth outperforming the value stocks based off of this chart. And then diving into our sectors that we watch. This is our sectors over the last week. Last 5 trading days, and we can see that it is all red. We've got nothing in positive over the last trading week. Our best performers is the agricultural fund down about 1.3%, gold only down 1.8%, and consumer staples down about 2%. Everything else quite a bit more. And then when we get down to the bottom of this chart, for the worst performers, we saw a big sell-off in the XOP for oil and gas exploration, Arc Innovation down double digits, as well as solar, alternative harvest for cannabis, natural gas down over 10%, FinTech down over 10%, quite a few other sectors down, 5, 6, 7, 8, 9%. So this was a broad-based sell-off. No sector that we're tracking here had a positive performance on the week, so it was a pretty broad-based sell-off on all these sectors that we're watching, and I think we did probably see that flush out though, and we'll probably see a different picture going into next week. And then take a look at our U.S. oil chart. We were talking about for some time now, especially once we lost this 50-week moving average, and then especially broke down below this channel line 2, that the bias was definitely continuing to head lower on oil, and we were looking for a possible bounce, maybe all the way down to our 200-week moving average, which currently would put us at about 63 or so per barrel, maybe get us as high as about 66. And so we're kind of looking for a possible bounce at those levels, but we also first have to contend with this support level, which is about 76.50, which it looks like we are potentially doing a short-term bounce off of just above those levels. But once we break down, or if we break down below that 76.55, which I still assume we probably will, then we'll likely be looking for that bottom in that 63 to 66 range on oil. And if we do get down that low and we see it hold support at those levels, that could be a pretty nice re-entry point into the oil markets, because I don't think oil is going to just completely collapse and get super cheap again. And so I would imagine that if we do get down to those levels, that would likely be a bottom, and we could probably get some nice tradable upside off the energy space at that point. But for now, I'm either short or sitting on the sidelines in the oil sector. And then take a look at our commodity index, the CRB Index. Big development on that this week. This weekly candlestick not only broke below our channel trend line, which has been intact since the COVID lows, it also broke down below our 50-week moving average. So 2 major breakdowns, and so this definitely is looking like it's heading to the downside, but we are also at a support level just above that 267 level on the CRB Index. So again, we might get a short-term bounce. If we do, we'll probably retest this channel line and that 50-week moving average, and then I'd suspect we'd probably roll over. If we do see a breakdown below that 267 on CRB, there's a good chance we see a significant drop down, potentially as low as 233 to 240 would probably be my next downside targets on the CRB Index, and that might actually be a decent little shorting opportunity, but I'd want to see us get below the 267 on that CRB Index before I entered a short trade on that. And then taking a look at our consumer discretionary versus consumer staples, we can see that consumer staples really outperformed on the week. Anytime we're heading down on this chart, that's consumer staples outperforming. So we saw a big move to the defensive sectors, which makes a lot of sense when we had a big red week, and that tends to be the case. It's also why we've seen consumer staples tend to outperform for the most part, really all the way back into November of last year, as we really started to see the market top out and roll over from there. So nothing really unusual here. Likely going to see it potentially retest that 0.65 and ultimately head lower at some point. And then taking a look at our all-world ex-US index, so this is our global markets minus the United States. We are getting down to a key support level right around the $44 level on this chart. We'll see if the global markets have a short-term bounce as well. If we do, we probably look for that to get back up to about $47.50 before ultimately rolling over and heading lower and likely heading to that $44 level on the BEU. And then when we take a look at our high yield corporate bonds, we did break down below the June levels that we were at, which was sitting at about 73. So we're even lower on the corporate bonds now. So I think that's a little bit of a warning as well for the broader markets longer term, that things are still not looking good when your high yield corporate bonds are selling off. I don't think that's a very good sign for the economy, and we are looking like we could easily get back down to that 69 level after, which would likely be a little bit of a recovery if we do get that upside bounce next week. But ultimately, it's looking pretty likely that we can retest that 69.65 level, which is ultimately where we had closed out the weekly candlestick on our COVID crash. So high yield corporate bond levels are so depressed at these levels now that we're in basically COVID crash type territories, and so I think that's definitely a warning sign for the markets going forward. And then jumping into our metals, taking a look at our precious metals, gold first. We did see that last week we broke down below the 200-week moving average, and we closed below those levels. So we certainly were either looking for a whipsaw to get back above that quickly, or continue to selling pressure to the downside. We didn't get the whipsaw. We continued lower on gold this week, and it's looking like we're going to probably continue that trend. We'd be looking for some downside targets at that 147.50 level would be a likely spot for some support, or if we do head lower from there, the next area of support we'd be looking at would be about 136 on the GLD. And then our silver prices, we're sitting at about just 1736 on the week for silver. We look like we're headed lower on this as well. Likely going to retest this previous low, which had us at about 16.25 on silver. If we go below there, then we'd be looking for some support at this 1540 or so level on the SLB. And then let's take a look at our interest rates. So our 2 years had a big week this week. We're sitting at about 4.21% on our 2 year. So a big move to the upside on our 2 year interest rates. Also a big move to the upside on our 10-year interest rates, although some of that did retrace. We had got as high as about 3.83% on the 10-year. Ultimately closed the week out at about 3.69. So we'll see how price action develops next week. This could be possibly a short-term top in 10-year rates. I'll be keeping a close eye on that, but ultimately I think we are still heading higher, and there's a good chance we're going to at least test this 4% range on the 10-year, if not potentially a little bit higher. And then taking a look at our 30-year interest rates, also a move to the upside this week. Also a pretty decent retracement from the highs. We had got all the way to about 3.7, 3.72. Ultimately closed the week out at about 3.61 on the 30-year. And then when we look at our yield curve, we talked about that actually in one of our short videos, but the yield curve is at historic levels in the negative territory, where it closed the week out at negative 0.521%. That's the lowest level we've ever seen a reading on this chart, going all the way back into the 80s. On the last two times that we dropped below the negative 0.22% level, we were in 50% plus correction territory. That was the dot-com crash as well as the great financial crisis. So both of those were some pretty deep corrections in the market, and while it doesn't guarantee that we're going to have that, the last two times we've been at these extreme levels, we have seen a pretty deep correction. So I think this is one of the mini macro charts that I look at that's definitely flashing some warning signs longer term as well. And then jumping into our VIX, we did see the VIX spike this week. This could be also a potential sign of some short-term capitulation, as we spiked up to about 32.5 on the VIX, ultimately closed the week down just below 30. And so we might see the VIX continue to drop a bit going into next week, especially if we get this short-term rally that I'm expecting. And if we do, we could potentially get all the way back down to 25 and retest those levels. And then if we'll likely see a sell-off from there, I'm expecting. And then we'd most likely see the VIX pop back up and retest 30, if not go higher from there. And then take a look at our put call ratio. Anything above 1 is elevated put buying protection. We've actually seen some marks over the last few weeks that have been above 1.25, and ultimately we actually saw a mark above 1.5 in the last week or two, and we haven't seen a elevated put buying protection on those kind of levels going back all the way to the COVID crash back in February and March of 2020. So we're also starting to see some pretty big extreme put buying protection going on in the markets as well, and so that's also, I think, a warning sign that people are getting pretty cautious and defensive, and people on that kind of percentage levels typically doesn't happen unless a lot of institutional buyers are getting cautious, which we've certainly read some reports about that. And then diving into our dollar, the DXY chart, we've been talking about how this is one of the most important macro charts in the market right now. I've been watching the dollar index daily and very closely. We can see that obviously we had a big rise in the dollar this week that coincided with a big sell-off. I don't think that's any big surprise, although it does look like we are approaching some levels where we might hit some resistance. We've got a massive channel trend line that goes all the way back for quite some time. We can actually scroll this thing back all the way to the top before the financial crisis. So actually it was the rebound on the bottom from the financial crisis. So the first tick mark that we started with this was in 2009, and we can see it's acted as resistance many times through many years, and we are now approaching those levels again on the DXY. So that seems like a pretty logical place for us to take a pause. I do think we are having some extreme readings in the dollar and likely going to head higher, and I'm actually thinking we will break above these levels, but because this is a pretty major channel trend line that's been respected for quite a few years, I think it seems like a logical place for the dollar to take a pause, at least head sideways or potentially correct a bit, and if that happens, that'll probably set the markets up for that short-term bounce as well. And then one thing I've been starting to look at as well that's kind of interesting is actually the DXY chart in relative terms to Bitcoin. Now we know the dollar has an inverse correlation to Bitcoin, but when we actually start to graph it out and take a look at dollar in relative terms compared to Bitcoin, I think that gives us some interesting technical indicators to watch, and we can kind of see on this that we're actually seeing a dollar breakout in relative terms compared to Bitcoin as well, as we broke above this 0.006 level. And so things are looking pretty bullish for the dollar on relative terms for Bitcoin as well. And then we'll go ahead and finish up the week on Bitcoin, taking a look at where we're at. We were bearish. We put a short on when we were sitting at about the 22.5 level. I actually closed that short out as we saw this Tom DeMark 9 indicator come in a few days ago. That's a pretty reliable reading that oftentimes signifies a short-term bottom. And so we took the short off, and I think there's a good chance we chop around maybe sideways for a bit. So I'd expect that we'll probably trade around in the range of about 18,000 to about 21,000 on Bitcoin for a while. Probably see some sideways choppy action, but ultimately we'll likely be heading lower. But I probably won't re-enter a short trade on this until I see some price action below that 18,000 level, and then from there I think we're likely looking at we've got to retest this anchored VWAP position, which is just at about 17,900, but once we drop down below that level, then I think we're got pretty much a clear sailing to the bottom, heading down to about 14,000 before we probably see the next level of resistance on Bitcoin. So looking for some shorting opportunities once we get below that anchored VWAP with that $14,000 price target. All right, that's going to do it for the week, so make sure to download the ToroAlerts app on the App Store. If you haven't already, we've got one for stocks and one for crypto. And give this video a like and a share, and we will see you next week.